What is up, everybody? Jay Costa here. Welcome back to the channel. If you get any value out of this video, please do me a favor and smash that like button down below, and also consider subscribing. We are slowly building a community of people who are trying to build wealth, specifically in real estate, using a home equity line of credit. So if that interests you, or if you're just getting started on learning how to use a HELOC to build wealth, consider subscribing down below. Now, on to the video. Now, if you're new to HELOCs, I definitely recommend checking out my previous HELOC videos. And in those, I go over what a HELOC is, how to use one, what to use them for and not use them for, how the payments work, and how to obtain one. I will put a link in the description box down below, as well as up here in the corner. Now, in one of those previous videos, I did cover how the payments work on a home equity line of credit. But in that video, I really only covered one stage of a home equity line of credit, the first 10 years. You see, a HELOC has two stages or periods. Number one is the draw period. This is those first 10 years of the HELOC where you're only obligated to pay interest-only minimum payments to your lender. As long as you only pay those minimum interest-only payments, your balance will stay the same. It will not go down. The only way for the balance to go down is if you overpay deliberately each month. And number two is the repayment period. And it's exactly what it sounds like. It's when the bank gets repaid the money that they lent out to you. And in this video, I'll discuss how the repayment period works, what interest rate you're paying in this repayment period, how your payments are calculated, as well as whether or not it's a good idea to hold a balance on a HELOC for over 10 years, or is this something that should be completely avoided if at all possible. Now, before I get into details, obviously I am not a financial advisor. Don't take anything I say as gospel. It's really just my own understanding based on my own research for my situation. Your situation could be very, and probably is very differently, specifically with HELOCs, because home equity lines of credit are different lender to lender. Each lender has different terms and policies that they use on their HELOC program. So it's very important to know what you're signing up for with your lender and ask as many questions as possible to your lender direct. And if your lender is different than what I'm saying in this video, drop a comment down below. I would like to know what everyone else is finding, especially because I applied for my HELOC back in 2021, and obviously the environment in regards to banks and lending out money is much different now. So I'd be curious to see what the differences are that you're seeing out there applying for new home equity lines of credit. So let me know. So back to the topic at hand. Obviously, like I mentioned, the first period of the home equity line of credit is the draw period, where you can draw from your home equity line of credit as much as you like up to the limit, and you only have to pay minimum payments of interest only. The balance will stay the same unless you deliberately pay extra every month, and the interest rate will be tied to the prime rate, which is set by the Federal Reserve, plus a certain percentage that you and your lender agreed upon when applying for the home equity line of credit. That's called the margin. So using my case as an example, as of right now, April of 2023, the prime rate is 8%, and the margin on my specific HELOC is 1.04%. So that basically means that I'm paying an APR of 9.04% on any balance that I have on my HELOC. And each month it can and will change based on what the prime rate is at that given time. This means that the home equity line of credit is a line of credit with a variable interest rate. It's not a set interest rate like a mortgage. It can and will change over time. Now, the repayment period, on the other hand, is much different than the draw period. First, the line of credit, let's call it, that you had in the draw period, the first 10 years, turns into an amortized loan, where you as the borrower are now obligated to not only just make interest-only payments, but you're obligated to pay both principal and interest payments until the lender gets repaid the sum of money that was in your balance. And if you don't make these principal and interest payments, the lender can and will put a lien on your property. This now amortized home equity loan, let's call it, usually lasts about 20 years and now acts as basically a second mortgage on your property that you gotta pay. I found this chart very helpful from Flagstar Bank, showing the full amortization of the 30-year period on a $100,000 principal balance. As you can see, the principal balance stays the same for the first 10 years while you're paying interest because they're interest-only payments. Then the balance starts going down after that because that's when the repayment period starts, and you're obligated to pay both principal and balance until the lender is repaid completely. In regards to monthly payments, using this figure, $100,000 principal balance with about a 9% interest rate, because that's kind of where they are right now, your interest-only payment for the first 10 years would be $750 a month, and your principal and interest payment the last 20 years of the 30-year amortization would be about $900 a month. Now, this chart only shows a fixed rate of 9% the entire 30-year time frame. And since HELOCs are generally variable interest rate products, this is not how your HELOC is going to behave. But obviously it's like this because we don't know what the future brings in regards to interest rates. So a chart like this can only really show a fixed rate. Now, the interest rate in the 20-year repayment period compared to the 10-year draw period is usually the same. It's going to be a variable interest rate that's pegged to the prime rate plus the margin that you agree. So it is not a fixed payment. It could vary up or down for 20 years. Among other reasons, because it's a variable interest rate, I would highly suggest that you do not hold a balance on your home equity line of credit for this long. Frankly, I would almost never suggest holding a balance at all for more than like a year or two max on a home equity line of credit. And the reason for that is that the variable interest rate takes away the main advantage of taking a loan or a real estate backed loan out. And that is having a fixed payment in perpetuity until it gets paid off while the value of the property goes up over time. That's the whole point of real estate investing in general, at least long-term real estate investing, because you have a fixed payment with a specific mortgage, right? But rent, if you're renting it out, rent goes up. You can even say the same thing about a primary residence. You have a fixed payment every single month until you pay off that loan, and the value, generally speaking, of the property, of your primary residence as well, goes up in value over time. Now, this is assuming you're using real estate or maybe some other income producing asset to put this money towards. So what options do you have in order to avoid getting to this point? First, you should know that even though this is the most common way that a HELOC is set up, not all of them are set up the exact same way. There are other types of repayment periods as well that certain lenders may have. That is why, once again, it is very, very important to know what you're agreeing to and to ask questions of your specific HELOC lender. Some different types of repayment options that certain HELOC lenders may have that are different from this would be: one, a balloon payment, where basically you're obligated to pay back the full balance of what you owe on the HELOC to the lender in one lump sum right after the draw period. Number two would be a fixed rate option or a fixed rate loan. A lot of HELOC lenders turn the variable interest rate HELOC into a fixed rate amortized loan in those last 20 years. And even if yours isn't like that, you probably have the option with your HELOC lender to convert it to a fixed rate loan for those last 20 years. So definitely check that out to see if it's an option for you. And number three is a reset or a refinance of your home equity line of credit. Many HELOC lenders allow you, after that first 10-year draw period, to reset or refinance, or you're basically opening up a new home equity line of credit and using that new one to pay off the old one, and you basically start from square one with a full 10-year draw period in front of you. But be careful if this is the case, because it could just lead you down a path to get you into more debt that you cannot pay off. That is it for today, guys. Thank you so much for tuning in. Like I said, my name's Jay Costa. If you have any questions about these home equity line of credits payments and how they work, drop a comment down below. I would love to start a conversation with you and answer any questions you may have. If your experience is different than mine, if your HELOC is set up different than mine, drop a comment as well. I would love to see what's out there. Obviously, since the environment in home equity lines of credit has changed drastically in the last year or two. Once again, I appreciate you tuning in, and I will see you next time.